So let's talk about fraud. Fraud's a very topical issue at the moment. You're probably all aware that the government has published a national fraud strategy. Also, just at the moment, the Online Safety Bill is going through Parliament, and the Online Safety Bill is trying to prevent fraud happening on some of the tech giants' platforms, requiring them to do quite a lot of things. So I think that as a topic, it's a hot topic, it's important. I'm sure that all of you are concerned to try and keep fraud out of your systems. And what we're hoping to do today is to give you some ideas on best practice in terms of defeating fraud and keeping fraud away from your systems and from the financial sector in general. So I am going to ask the panel to introduce themselves. So if the panel members would be kind enough to now reveal themselves, I will ask them in turn to just show themselves. Let me put that on full screen. Okay. Thanks very much. Chris, would you like to start, please?
Yeah, of course. Thank you. And afternoon, everybody. Thank you for joining. So, yeah, my name is Chris Parker. I am the Fraud Analytics and Threat Management Lead for NatWest Group. So I have a focus upon supporting analytics through products, through modeling, through essentially efforts to sort of stay ahead of fraudsters and utilize data as much as possible. And as a part of that, I product own our infrastructure data and authentication transformation chapter. So lots on, and that's 22 years I'll have been at NatWest next month, and over 10 of those in fraud prevention.
Thank you very much, Chris. And am I right in saying at NatWest that fraud is separate from anti-money laundering? Is it sort of treated?
Yeah. At the moment, we're sort of structured in what they refer to as centres of excellence. So we do have a fraud prevention centre of excellence at the moment, as well as a fin crime centre of excellence. But we work sort of hand in glove, because obviously there are differences, but equally lots of similarities and lots of ways in which we can help one another.
Thank you. Alex, would you like to introduce yourself?
Sure, thanks, Jane, and thanks everyone for joining. I'm Alex Melki. I'm Vice President of Artificial Intelligence at Jumio, so responsible for all the AI ML development that we are doing here, and all the ML components in our products. Range of applications, computer vision, natural language, risk modeling. Also very much involved in the aspects of legal aspects around ML, around data, and ethical development of AI. And I've been at oh, sorry.
No, carry on, Alex. It's fine. Sorry.
Yeah, and so I've been at Jumio for a bit above 4 years at this stage, trying to open the AI office in Montreal.
Thank you. Conrad, would you like to introduce yourself, please?
Absolutely, lovely to be here. My name's Conrad Leonard. I'm based in London for MasterCard, and I currently look after commercial activities for our acquisition in the cryptocurrency space, a business called CipherTrace, and we assist organizations around the world to detect fraud and anti-money laundering in cryptocurrencies. Prior to that, at MasterCard, I looked after a group of products around fraud in real-time payments, so in account-to-account payments, specifically globally. And I've had experience at fraud and AI vendors on the commercial side as well, always looking at card payments and account-to-account payments. So excited for an enthralling discussion in keeping fraud out of online payments. Certainly a challenging topic, and one I look forward to garnering views on. So lovely to be here. Thank you. Thank
you very much, Conrad. Monish, would you tell us about yourself and your role?
Thank you, Jane. Good afternoon, all. Thank you for having me here today. Very quickly, Manish Branchpe. I'm a director at EY, and within EY, we've created a new utility called RiskOps, which looks at everything from a technology angle in the predominantly risk space, but mainly focus in the fraud domain. What we look at is basically bringing new capabilities, new concepts, and new ideas, both from a technology angle, but also from a data science point of view, to organizations across both the FS and the non-FS space in EY. I've been in EY for over a year. I've prior to this worked across the banking space in the US, across Europe, and in Southeast Asia, looking at protecting every organization and every form of fraud for more or less last 17 years in my experience. Thank you for having me.
Thank you very much, Manish. As you can see, we have a very experienced panel. The thing I wanted to begin by saying was to talk a little bit about how fraudsters exploit technology, because we're going to talk about how can we defeat them, but they're not, they're obviously people who are able to exploit technology, and they will look at where there are gaps and see opportunities. They don't have to worry about legislation, they don't have to worry about borders, they don't have to worry about anything. They can effectively do what they wherever they see a gap, they will exploit it. And new technology and moves to online, people doing more online shopping, people banking online more, using their mobile phones, all of that has increased the opportunities for fraudsters. So fraudsters will manipulate AI algorithms, they will create false identities, they'll generate false information. We've all seen how many scams and phishing emails everybody receives. And we're going to go on and talk a little bit later about what the government's doing in some more detail. But what I want the panel to do is to suggest what is the best practice to defeat fraud. And one of the things I wanted to start by doing was to talk about the types of AI. AI is a very generic term, means lots of different things. How can we use AI to defeat financial crime, specifically fraud? And the first thing I wanted to talk about was generative AI. Chris, I was going to come to you to maybe if you could explain the concept of generative AI and say why it's useful in preventing fraud.
Yeah, certainly can. So yeah, as the name somewhat suggests, I suppose generative AI really is the generation of any number of different things using artificial intelligence. So that could be voice, could be face, could be imagery, could be data. There's conceivably all manner of things that the artificial intelligence can be sort of pointed to, and the ways in which that data is generated and the purpose of that obviously then equally can have both good and bad outcomes in terms of the intent and the direction of use. So we certainly see it within our business and recognize it for both us and our customers as a threat. Obviously it's a threat that's growing, and there's obviously experts on this call who thrive in the use of AI for good. Unfortunately, there's a lot of criminality that recognize and are starting to harness AI for bad as well. And some of the generative AI that seemingly is getting a lot of the headlines at the moment is around image and voice generation. Obviously, it's not the only sort of uses, as I've said, but you are now seeing potentially or almost like for like voice interpretations of particular individuals. In the US, there's been cases that have been quite publicized around sort of hostage type scenarios where people's daughters or sons will call a parent and say they've been snatched, and the fraudster then comes on the phone and asks for money to sort of cover their release, and that voice wasn't the child. It was generated presumably from social media or other sort of excerpts. You've seen this last week within the UK, one of our leading sort of financial I suppose advisors or experts, Martin Lewis, has been mimicked in both voice and face, and was I think selling sort of spurious cryptocurrency. So there's always opportunity for individuals to use these things for bad, but fortunately for us, we and our peers and the kind of broader industry are finding lots of opportunity with AI, and certainly sort of generative AI, and if you expand that out to sort of include some of the sort of sister capabilities such as kind of machine learning, there's an awful lot of opportunity for us to look to try and find the needles in a haystack. One of the realities of fraud and also scams is that of our transactions, a good 99, probably 99.5% of the transactions are genuine. So we really are looking for very infrequent events within that data. So the ability to create models that are driven by that machine learning or that kind of AI type methodology to identify the trends, identify the data features, really harnessing on what it is that maybe makes a particular transaction high risk, or perhaps would suggest that a customer is particularly vulnerable to a certain threat is incredibly powerful. And we increasingly, and as you said, we'll touch on some of the legislation later, but prevention is definitely better than cure. It's certainly better than detection. So if we are able to identify individuals who may be at greater risk, the sooner we can do that, the sooner we can educate them and support them, the better for all involved. So there's definite opportunities there. We find with the kind of modeling capabilities, we're able now to much more specifically target those trends, those threats. And equally, where we perhaps relied on more kind of classical rules and policies, we're even finding now that by using large data sets and sort of driving that across those rules and policies, we can find ways in which we can optimize it. So again, as a bank, when you're dealing with that very high genuine versus fraudulent rate, the impact we have is also felt by customers transacting normally. So the more we can train and we can use sort of synthetic training data to improve the rules we use, the models we build, the more impact we can have when we have to, when we intend to, when the transaction is fraudulent. But equally, the less impact we have on genuine customers that are just looking to kind of do their day-to-day banking and get on with their lives. So huge possibility.
Yeah.
Sure.
Thank you. That's really useful. I mean, one of the things we should probably talk about, Monish, I'd like to come to you to talk about some of the smaller companies and how they might be able to do this. I mean, this is not, you can't just adopt AI. You've really got to do quite a lot of things before you look at technologies, haven't you? You've got to make sure that you are, for example, doing a proper risk assessment and looking at your vulnerable customers that Chris has mentioned and things of that nature before you start to say, where can we deploy this new technology? So I'm sure that in your role, you've been advising smaller companies about that. And then, Conrad, I'd like to come to you and talk about the crypto market.
So, Jane, very quickly, I think it all starts with as you said, the risk assessment, right? The risk assessment and the risk appetite. I'm probably going to make a controversial statement, and I'm going to stand by the controversial statement is, I don't think anybody on this call will actually stand by and say we'll get rid of 100% fraud. So there is always going to be, all we've got to do is minimize the impact to our customers. So the risk assessment and the analysis of your customer base, it's the primer facie where you start your analysis from. Technology and capabilities associated with the advent of this is only as good as first of all, your risk appetite, B, the amount of data that you've actually got to actually play with, right? So one of the key things for larger organizations that Chris, potentially Conrad, or myself have come from as well, we've got bigger organizations, bigger pockets to fundamentally help with these capabilities. For mid-tier and smaller organizations, now we've got to start to think about a strategy of where potentially we have a wider scale of capability and alignment between potentially fraud and fin crime. And how do we maximize the bang for the buck? And where do we actually kind of invest? The first place I would probably recommend is kind of get your fraud strategy, but the next best thing is get the data right. Right? Once you've actually got the data piece absolutely accurate, then technology, because it's as good as you put the technology, but if you don't have the right amount of information, data, or signals going in, outputs of the point that Chris mentioned in terms of building the GenAI model becomes very limited, because if you don't have the right information going in, there's nothing that black box or that technology can actually allow you to deliver as well. Besides which, as we progress through the new capabilities, there are activities around third-party information, right? So you can actually rely on third-party signals from behavioral biometrics or third-party signals from malware or digital devices. It's fundamentally kind of bringing those signals into the organization as probably data enrichers more than anything else, and then pushing the capability out to a wider sector and the segment as well, both again at a card level, or at a payment level, but actually looking at this more from a customer level point of view.
Sure, thank you. And Conrad, is there anything in particular in the crypto sort of in general cybersecurity area where you think that's important to emphasize here?
Well, I'll probably match Monesh's controversial statement in that it is possible to get rid of 100% of fraud. You just have to get rid of pretty much 100% of payments, right? You know, there and as Chris would say, you know, very, very few transactions as an aggregate. And at MasterCard, we process 60,000 transactions per second at peak on just the card network alone. We touch 3 billion people every day, let alone on the account-to-account rails in terms of number of people that we touch. However, when thinking about crypto, what's interesting to note is that when we see transactions in cards and payments to crypto merchants, we do on average see around 4 times higher chargeback rates and fraud rates from fiat to crypto payments than we do in, for example, just a traditional card to a non-crypto merchant payment. So we do see higher amounts of stolen cards effectively and account takeover scenarios being used at crypto merchants to buy crypto. And that's not surprising when you think about what you can do once fiat has been onboarded to a crypto merchant. If that crypto merchant has not done the right level of KYC and the right level of due diligence on that person, it's relatively easy for a criminal to open an account at certain exchanges. And once they've done that, they can then work their way from crypto to a different cryptocurrency, perhaps through a mixer, and then actually release the funds into a different bank account all the way across the world. And for all intents and purposes, that money has been lost and stolen. So crypto is slightly unique and different. However, there are also some striking similarities in that payments are actually very traceable on the blockchain versus not in the blockchain. To some extent, fiat payments and the mess that the correspondent banking network is in, to some extent, is highly obfuscated and is able to be very manipulated by fraudsters and tricksters as well. And I think the key word for us at MasterCard is interoperable. I think what we're going to see is a proliferation of interoperable technologies from blockchain and crypto into fiat currencies to hopefully create an identity-based layer. MasterCard, we're to some extent talking about this as the multi-token network, where you're able to have almost cryptocurrencies traded on traditional payment rails, where there should hopefully be a higher level of KYC and due diligence that should in effect enable there to be a greater recovery rate when there is fraud and a lower basis point of fraud. So lots to talk about when it comes to the crypto space.
Thank you very much. And I can see we've got some questions coming in, which I can also see Chris is answering, but we'll come on and talk to some of those, the issues that have been raised towards the end. Alex, I wanted to turn to you now and ask you if you could talk a bit about the issues around identity verification. Obviously, we're all aware of people using false identities, either pretending to be a known individual or making up an identity. Can you talk a little bit about inherence is a term that I've read about. I'd like to sort of understand what that means in the identity verification space.
Yeah, for sure. And perhaps here echoing one point that Conrad was making, which is exactly the importance of the KYC process and the onboarding. And so, because that's the first point at which you can already start thinking of the risk profile of the users that are coming in. And so that's a very first step that is important to get right. And that's where the identity proofing can come into play with in association with all the AML compliance checks that you can do on top of that. And so the inherence is exactly this idea that we are moving to factors of authentication that are inherent to the person and not necessarily what they know, what they have, but who they are. And so essentially around biometric factors, whether we are talking about face, about fingerprints, about sclera or other forms of authentication based on biometric factors. And here the interesting part of it is that we are now in a position to have systems that are quite accurate and very low friction using inherent factors. And these are things that are also very usable from a user perspective. How many passwords have you forgotten? How many knowledge questions have you had to remember to get access to your accounts? Whereas going around with your face or other biometric attributes, this is a no-brainer. And once you have a good user interface for that, that's very user friendly. So that's I think one of the reasons why we see this shift towards inherent factors. And that's also where you can use this inherent factor to do some strong associations between credentials. And so going from the physical user to their credentials in terms of government issued ID documents, in terms of also association with other data points, whether it's you are associating devices with them, whether you're associating physical addresses. So you start linking these different credentials and connecting with the inherent factor. And then it enables you also to have an ongoing strategy of through the authentication. And that's important because what different cases have revealed, and here probably in the UK you've heard about this tragic case in the use of an e-scooter by an underage boy who died. And the authentication was legitimate through a verified device. But that was not a legitimate user. And because there was no age verification as part of the authentication, that's why a 12-year-old boy ended up dying using an e-scooter. So there is here a very strong case to be made about the use of these inherent factors.
Thank you very much. Thank you, Alex. I wanted to just touch on the finance sector compared to other sectors, and whether the finance sector is different from, say, the tech sector, telcos. Is it? It seems that in the past, finance has been slower than other sectors to adopt new technology. I mean, I say that, although I'm somebody who worked at Mondex, which was one of the first e-money companies, and certainly that was all about technology, even in the late 1990s. But people do criticise the finance industry for being slow to adopt tech. Conrad, is that a view that you would agree with?
I think it's an interesting question to consider, and I would argue that when thinking about MasterCard, we're very keen nowadays to consider ourselves very much a technology company, primarily that has happened to focus on payments over the last 40 years rather than vice versa. I think that it depends entirely as well which bit of the finance sector we consider. So, for example, 6 years ago was at an AI machine learning company for fraud prevention, which was deploying live models inside businesses like TSYS and WorldPay, 6-7 years ago, right? And to some extent, that wasn't mainstream press and in the media as much as it is now. It's almost expected that your tier one banks will have a machine learning or AI-driven solution to enhance fraud detection, as an example. I do, however, to almost counter that, think that from a consumer's perspective, it can appear that AI and technology in finance has taken a lot longer to sort of become that word again, interoperable. So give you a very small example. I went on a stag do recently and we all split our payments on something wonderful called Splitwise, where you kind of create a very simple ledger as to who owes who what around accommodation or parking or whatever that cost may be. Now, that's all well and good, but I still have to share my bank details manually to that group on a WhatsApp group for them to then go into Splitwise, then be able to go back into their online banking to create a push payment into my bank account. Now, I would consider that to be a slight failure of technology, in that I would think that at this point, with the Open API framework and open banking, things like that could be a little bit slicker. Technology will always take longer in finance, and particularly in retail areas of finance, because of regulation or indeed lack of. I think that big players in particular are very hesitant to be the first mover in a space where they know there are potentially lawsuits coming down the track always, in terms of privacy and GDPR and the right to be forgotten and all of those other good things, which I believe on a personal level are good from a consumer perspective. But I think it's important to look at why certain institutions, and the challenger banks in the UK are a good example, have done very well over the last 5 to 10 years and have really won a lot of market share. I believe it's because they've seen a gap. They have been light touch regulated. They've done brilliant things around becoming e-money institutions first and then becoming first movers. And then you've seen your incumbent players such as NatWest and HSBC then become very happy second movers and be willing to take up that mantle to then develop and grow the technology second.
Yeah, I think that's an interesting perspective. I do think that fintechs have been perhaps more open to adopting technology, but I also think that for some consumers there is this business of, it feels like a barrier, particularly if the technology feels quite intrusive in asking you to do things. And one of the suggestions that the government has is that we need to educate people more about why they need to do such things in order to to make sure that criminals don't succeed, because a lot of people are resistant to doing things. I think there's a piece that we haven't necessarily talked about, but that consumer education piece about what can you do to protect yourself and why you shouldn't feel too resistant if you're asked to do certain things. Alex, is that something that Jumio has had to grapple with a little bit?
There is always an aspect of customer and user education indeed in the system. I would say that it's part of always a collaboration with our own customers, so business customers, in terms of how to structure their interaction with their users and how to really point out the importance of certain behavioral patterns, especially when we're talking about this authentication coming back to your financial institution, or how you go about your interactions with it. So there is a bit of that, but indirectly for us.
I think if people, if financial institutions explain to customers why they're being asked to do things, that will help. I think the assumption that people will just accept whatever there is perhaps not right. But if anybody wants to come back on that, just let me know. I think it's an interesting point. So getting this balance between customer friction and compliance is quite tricky, because you want to do certain things to make sure that your systems are safe. But if that's causing a barrier, I'd like to talk about whether there are some service benefits to carrying out better KYC. Monish, we talked about this before the session. Is that something that you've seen?
And I think it's going back to, I think, aligned to your previous question and this one. It's more on behaviors, right? So the first question is, there's adoption in technology in other industries because the customer behavior has adopted quickly, whereas I'd say not in the finance space, in the banking space and traditional banking, it's kind of being a bit dated. And that's also purely based on the sort of profile of customers that they have. And that actually accounts exactly in the same way inside the bank as well. So traditionally, financial crime predominantly has been looked upon more as a compliance, something that I have to do as a banker, something I have to do as a bank, because the regulator is going to either fine me or it's going to be a reputational damage for me, as opposed to just kind of getting to grips of it and then putting it into the wider scale of the customer journey. It's happening now in the last 12 to 18 months, where KYC as a capability and perpetual KYC has brought about that whole wider capability of actually not just doing it as a compliance capability, but actually putting it in the customer journey as well. The alignment where we are actually now seeing, and there's a lot of, as Chris mentioned at the start of the call as well, there's a huge amount of overlap, a huge amount of collaboration between the FinCrime and the fraud space we see in the market as well, which is predominantly not just from a technology point of view, but because we are servicing the same customer, we are protecting the same customer, understanding that we actually need to kind of have a single touch point to that individual customer from either a KYC point of view to get their data from a fraud perspective. So kind of have that as a single point, but also potentially kind of combine the intelligence we get from anti-money laundering, transaction monitoring plus fraud real-time decisioning as well. So kind of build those economies of scale. And that whole ecosystem has kind of been put on steroids, for lack of better words, with now the scams and the money mules framework coming in place as well, right? So money mules compliance management is the responsibility for financial crime, but actually it's a frontline fraud challenge, for lack of better word, right? To continue to kind of protect our customers and continue to protect for the banks to protect their incumbents as well. And that's where the alignments now, as we progress through this in the next few years, I kind of see as a result of the technology maturity, you'll see both these organization divisions coming a lot more closer over a period of time as well.
Yeah, Chris, is that going to be the case, do you think, in NatWest, even in a large bank, that you'll see fraud and FinCrime or AML, whatever, becoming part of it? I don't know whether people have seen it, but if you've seen or read the book which Tristram Hicks and Dr. Nicholas Gilmore produced called The War on Dirty Money, they're very keen to say that many of the terms that we've grown to like, even anti-money laundering, we should go back to basics and talk about the criminality that underpins all of that before we actually start to have more sophisticated methods of combating it. I mean, their suggestion is, and their book's very interesting if anybody wants to read it, because they do put in solutions as well. So Chris, do you see that AML, fraud, FinCrime, becoming more of a sort of holistic approach?
Yeah, I would suggest so. I mean, I think certainly for us that sort of AML aspect is already, deeply embedded within FinCrime. I think really one of the predominant differences at the minute is the speed within which we react to one versus the other. But I think, as you say, ultimately fraud or scams, they are going to a mule account who is then passing on to somebody else, and that person is a criminal who's then doing terrible things with it. So we are using, different words to essentially describe the same movement of money, which produces harm kind of in our country and globally. So yeah, there's a lot of similarities, and I think the world's going to get closer. Albeit if you've been in, any industry long enough, you see it as somewhat cyclical. But I think certainly for us, we're coming together more, and our data and our strategies are becoming closer to one another as well.
Thank you. I mean, the government isn't sitting doing nothing about this. Some may say, that's a lot of words and they should have done things sooner. But we've now got the Economic Crime and Corporate Transparency Bill going through Parliament. We've also got the Online Safety Bill. There was another sitting on that today. And we've also got this national fraud strategy, well, the Home Office fraud strategy, which is called Stopping Scams and Protecting the Public. And obviously the government is trying to hit back at criticisms and say, we are trying to do more. They are doing some good things. They're going to reform SARS. They are having a national fraud squad. They're going to replace Action Fraud. All of these things will be good. They are going to also have a new criminal, a new crime called failing to prevent fraud. So there's a lot going on. And I guess my question is, I mean, the question originally was will it happen quickly enough? And I think the answer is, you know, that many of these things, particularly like the reform of Companies House, are things that have been on the cards for years and really should have happened a long time ago. But, you know, what do you think of that strategy? Do you think that's going to make a difference, Chris?
Yeah, I mean, it will. I mean, as you sort of alluded to, I think if your kind of primary solution is government legislation and reform, you're going to be in trouble. You know, you can't wait for that sort of thing to come. However, it is obviously an important part of the puzzle. You know, you need to be proactive and within your own organisation, and then with your peers and broader industries, you need to kind of really push the boundaries and do more and more. But obviously, this is a multinational problem. It does require government level sort of focus and investment and attention, and in some instances, you know, regulation and legislation that holds people to greater account. And I think a lot of what is being outlined at the moment, and NatWest and our peers are very heavily involved in discussion kind of with government on it, is hitting a lot of the right things. You know, from my perspective, I talk often about there being sort of three factors within a lot of the fraud that we deal with, and the kind of criminality it's around risk, reward, and effort. And if you look at some of the areas they're looking to target, you know, that they're looking to really increase the effort from a forces point of view within the UK by making it far more difficult to abuse our phone networks. So, you know, action on call spoofing, on SIM farms, on SMS. They're looking to reduce the reward from criminals within the UK by sort of overhauling Action Fraud and making that data much richer and shared much more widely to then drive, you know, whether you're a big bank or a small new bank, you know, better insights as to what's going on and solve industry problems as an industry. And then obviously from a risk point of view, with the talk of 400 additional investigators and that focus, you know, what we want is for actors and fraudsters to you know, be of an understanding, if you do this in the UK, there is a very good chance you will be caught and you will you know, pay the comeuppance of it. So yeah, it's really good. And again, you sort of touched on, and others have either in the Q&A or elsewhere, that it isn't just a problem for bank or government. There are, you know, shared customers, and, you know, we all kind of broadly live, you know, in the same cities, the same countries. You know, we need more from the tech companies. We need more from telecommunications companies. It is not one of our problems alone to solve. It is a cross-industry challenge, and we all need to come together, because ultimately, you know, this money getting into the hands of criminals means they do terrible things that have sort of multi-generational impact. So there's a lot of good impetus from lots of different places. So yeah, you shouldn't wait for it, but welcome it when it comes.
No, I think that's a very good point. It's interesting because the National Fraud Strategy does say that 70% of fraud originates or has an element in it of international activity. Either, you know, the fraudsters are abroad, or they are sending the money abroad, and both, you know. So Conrad, is that obviously MasterCard's an international entity, and everybody these days has to work across borders. So, you know, do you think that enough is being done? The Home Office is going to have, I think Suella Braverman said she's going to have a big international meeting to discuss strategies. What can smaller companies do on that sort of international issue, do you think?
I think they need to lean in, as everyone does. I totally am in agreement with Chris in that we all need to come together, and by all, I think we need that to be as broad as possible, way beyond borders. Criminals don't respect borders, so why should we, to some extent, as organizations and those in power and in government, whether it's, you know, somebody growing narcotics on the other side of the world, if they're being sold on the streets of Britain and that money is being laundered across internationally, that concerns every single person across the deck, right? And is going to cause societal impact. So we have to be able to come together. I think what specifically small businesses can do is look at what's out there in terms of good advice. I think the government has done a good job from a cyber threat perspective, or as best as they can, in terms of providing information to small businesses around protecting themselves. I think, Jane, we also did discuss previously that unfortunately the weakest link in the chain of money laundering and fraud is human error still. It's either the kind of fat finger error on your own mobile phone, or it's being duped by a fraudster or a trickster. And I think Monish mentioned some interesting but sad examples around the use of deep fakes. And deep fakes are terrifying for a lot of reasons. But one of the most pressing on this call is the ability to, spoof somebody's voice, perhaps totally and utterly accurately, and convince a parent to send money to a new account, for example. Now, that would still come down as human error and a push payment fraud that has happened from your own account. And I think we need to do our best as an industry to protect consumers. And I think a bit of liability shift, to protect them would help. But we are absolutely all in this together, and we need to think of novel strategies. I don't want to be too much of a realist, but I do think throwing 400 bodies at it from a government perspective is a start. But with the advent of AI and the cheapness of running professional fraud shops around the world, it is a drop in the ocean, unfortunately. So the best way is through boosting education for consumers that are ultimately, generally speaking, in control of their own devices a lot of the time.
And I think that you're absolutely right. Everybody's saying the same thing. I'll let Alex and Monish come in and talk, but we have got some questions to answer as well. I think this business of sharing data, I mean, the collaboration is important. There's quite a few initiatives going on now about sharing data, and the Economic Crime and Corporate Transparency Act will make data sharing easier. We published a paper, I wrote a paper with Andrew Churchill, which the Payments Association published on data sharing. And I think people need to not just listen to their legal department, who will always perhaps be more risk averse than everybody else when it comes to sharing data. Monish, what do you think about that?
I think data sharing is definitely a big thing, but I think there are genuine restrictions and regulations why data should stay, because the owners of the data are the customers. But I think what we should get better at is sharing insights, right? Because the way the bad actors take advantage of the financial institutions is by attacking the weakest of the lot. And I don't mean that from a kind of a Masai Mara prey style point of view, but they look at the vulnerabilities in the financial system, and the vulnerabilities in the financial system can go from NatWest all the way down to one of the smaller building societies as well. And that's where we've got to kind of get a bit smarter, that if we don't actually have to share open banking, the point Conrad made, the way we are actually engaging on conversations with the government, as Chris mentioned, are measures as a totality. But the key will be, how do we start sharing insights, right? If there is a robo attack on a particular bank for a particular afternoon, how quickly can that bank kind of contact Conrad or MasterCard or NatWest and the wider ecosystem, and then potentially kind of make that message available so that people know and the organizations are aware? That's the purpose.
I think that's a very good point. What I was trying to say earlier was that data sharing, you're right, obviously there are privacy laws, quite rightly, but there are opportunities. If your sole objective is to detect or prevent fraud, then data sharing is permissible. And I just think there are too many times when people only listen to perhaps the lawyers. I mean, I'm trained as a lawyer, so I can say this, rather than making a judgment call on the risk and doing what is the right thing. Number of questions are coming in. I'm not quite sure what Casey's referring to about optimizing exemptions. Do any of you understand what recommendations do you have for optimizing exemptions? Maybe Casey, you could sort of explain what you mean by that. But Mustafa's question is, how can central bank digital currencies effectively mitigate fraud, and what strategies can be employed to highlight these measures and increase CBDC adoption? I think that's an interesting point. Maybe Conrad, that's one for you.
Yeah, I mean, thank you, Mustafa, for answering it. I think CBDCs could have the potential of greatly mitigating fraud. It does depend, obviously, if we mean therefore getting rid of cash as a construct in our society. MasterCard, likes to envisage a world beyond cash, and that's certainly what we've been working towards. From a civil liberties perspective, I think that cash has a place in society, and probably, I don't say always will, it's a long time, but it's hard to imagine in the UK, for example, or certainly the US, not having dollar bills or pound sterling in your back pocket if you fancy it. But the idea that your CBDCs could have cash-like equivalent digitally on a centrally stored ledger could certainly reduce counterfeiting a lot. And the idea that that ledger would be transparent and you'd be able to see at any one point in time where each digital pound was, I think that could do an enormous thing for fraud. However, almost back to Alex's point, problematic in terms of identity, right? All it takes is one bad actor to open with a false identity an account that can accept or receive CBDC, and you can have exactly the same problem that we've got with the traditional fiat world as well. And to your second point, or question indeed, how, what strategies can be employed to highlight these measures and increase CBDC adoption? I think there's little that can be done to speed up CBDC adoption, bar what's going on at a place like the Bank of International Settlements, which is to run sandboxes on CBDCs and to espouse those benefits of them. I think that like all good innovation, they should be market-led more bottom up rather than top down. I think the top down needs to provide the regulatory framework for CBDCs to flourish, and that system again to be interoperable with the current system. But yeah, really good question, and thank you.
Yeah, thank you. Thanks, Conrad. And if anybody else wants to, Alex, Monish, if either of you want to respond on that, let me know.
I was just going to add a very quick thing from Jane. Conrad kind of touched on it, but I think one thing we mustn't forget with this as well is a good number of kind of these bad accounts that receive funds from a defrauded individual are actually genuine accounts in the names of genuine people who themselves are either being victimized or are vulnerable and are moving money. So having very good sort of digital identities or other sort of means to truly identify an account and the owner of that account doesn't necessarily resolve the issue if that individual are themselves sort of perhaps complacent, but still supporting that kind of illicit movement of money. So it solves, as with so many things, it solves some of the problems and therefore should be progressed, but it certainly doesn't solve all of them.
Thank you. Thank you. Crennan has asked a question about, he says that sometimes AI, we're just talking about a logical couple of statements at code level, but are we using AI algorithms trained on large data sets of historical fraud cases to improve their ability to recognize emerging fraud patterns and adapt to evolving techniques? So which products do that? And I think that we did talk about synthetic data, Monish, before we began the panel session. So there are a number of products in the market which are using, sometimes they're using proper data sets, real data, and sometimes they're using synthetic data. Does anybody want to come in on that? Monish, would you like to talk about that?
So Chris, you want to kick it off and then I can continue on from the synthetic data point we spoke about earlier.
Yeah, I think so. So, I mean, obviously NatWest Group, we have a very large sort of customer base. We've got 17 million customers and move an awful lot of money via many different sort of mechanisms. So we, I suppose, unfortunately, we're in that sort of position where we do have the fraud data that exists within our environment. So without going into the nitty-gritty of it, we absolutely do use AI to create models trained on historic data. So we, as an example, we do look to see, are there strong data features that might identify somebody as being more vulnerable to, say, an impersonating scam than another person. And with that insight, we can perhaps then tailor subtle or more overt education. So we absolutely are, and increasingly are using historic data to help us sort of build better models to better target the kind of fraud. And Manesh, I'll let you talk about synthetic data.
And I think kind of to answer your question, there's a lot of organizations that are doing three things. Number one is, as Chris mentioned, using synthetic data to actually create assets that enable smaller organizations to take advantage of these assets, models, rules, digital decisioning capabilities, which help smaller financial services organizations and banks kind of get a step up in the arena where they do not have that level of sophistication or that level of data. That's the first thing. There are also products in the market which have invested in kind of developing these rules and models now. MasterCard, NatWest, MyX Bank, HSBC, we've got armies of data scientists who actually build the capability, but there are a lot of products and players in the market. Alex can tell you a few of them as well, from a Jumio point of view, that build an out-of-the-box capability that actually help you kind of come up with a model which has a federated input. Which by that what I mean is the model and the algorithm has been tested on huge data sets before they can be made applicable and tailored to the organization's point of view, whether it's your organization or smaller bank's organization as well.
Thank you, Manish.
And just
go ahead, Alex.
rebounding on this comment, I think that's also important for smaller organizations that don't have these large data science ML teams. There are vendors, and we also have some offers in that respect that leverage the consortiums of data. So you have then from the onset fraud systems that are performing at a base level, and that can then be fine-tuned onto the specifics of the use case and the specific use case, which is quite helpful for smaller organizations.
I think just to finish off, and I totally agree with whatever's been said, particularly by all three of my fellow panelists. I think to be honest, any vendor professing to come into a smaller bank, particularly a startup bank, sort of saying, "Oh, we're going to give you this silver bullet machine learning model from day one." It's just be very careful with that, is what I will say, because you don't have your own historic data to train that model, and we're still at that point. And you don't want to have the other problem, which is lots and lots of false positives, and then a very expensive professional services bill to have to pick up the mistakes of that model that's been built. But to Alex's point, there are what I would consider point solutions out there in the marketplace for things such as onboarding and customer experience that leverage AI from a more consortium perspective, that can provide a very good way to begin your AI journey. And the most important thing is make sure you collect data as you begin and flag it correctly, so that when you do have enough to build your own model and to bootstrap your own model, then absolutely you're in position A to do so. But Olivia, if you want anything else, happy to talk separately or what have you. So yeah, great question.
Sorry, I'll just say, Jane, very quickly, and I think Conrad touched on this. It's a very boring topic, but for everybody, large or small, data quality, it's a very critical element. If you garbage in, garbage out, it's a number of times I've come across. You build sophisticated models, very smart technologies, very acute algorithms, but you really don't have the quality of information that can actually result in the right level of output, and that has a massive impact to your investment or any initiatives you don't drive as well. Sorry, John.
And that's probably the topic for a whole other webinar. But the data quality, the data infrastructure, how you manage the consent also around the data, because we were talking earlier that ultimately a lot of the data is owned by the end user. So all these are critical prerequisite to have any meaningful ML AI strategy.
Thank you. I wanted to answer a question that Ross had raised about timings, because I think it is quite interesting that everybody assumes in this day and age that everything's got to be done immediately, and we've got ourselves into a bit of a mess, really, in that, you know, that the major factor is always speed for everything. So I think looking at, you know, whether we should be slowing down some payments is quite an interesting point, because some of the larger payments, perhaps, you know, particularly should be slowed down on the basis that more time could be given to the system to work out whether this is a payment that should go through or not. So I do think I can't see Ross's question anymore. I don't know whether Ross has taken it down, but I think that point is a good one. Should we have to do everything you know, as quickly as possible, or should there be some standards that we say perhaps the market might be better, and it might be that we could prevent more fraud if there were, for example, legislation saying you can't onboard, you know, within 2 hours, you need to, you know, at least have a certain period of time. Do you think that would work, or do you think that would just be counterproductive?
And if I can try and get the answer in that one, Jane, I think it's a very good idea, and I think it's a thought process that's currently being active in the segments of banks that we are working on. And it's not a question of to kind of drastically slow down all the payments, but if we start to kind of think about taking the speed out of payment for a set number of pays, then that potentially has a detrimental impact on the wider scams capability, and also the wider speed capability that the fraudsters are actually leveraging on. So it's an active conversation within the cross-banking forums that I've been on. It's not something that I've seen any one bank willing to do. I've seen a couple of tests in the financial services organization, but definitely a very good thought, and something that a lot of the organizations are already thinking on.
Thank you. Chris?
I was just saying, it's my fault you can't say it anymore, Jane, because I got too excited and answered it on chat. But but yeah, I think as was said, it's something that you wouldn't expect to see with everything. You know, when faster payments came through in the UK, you know, it was a huge boon really, and the fact you could move money immediately was massive, and one would hope it has enabled an awful lot of good kind of commerce and business growth. Obviously, it's an absolute delight to fraudsters as well, because you can move money just so quickly across all these different accounts. So I think, as has been said, I definitely see reasonable slowing of payments in certain kind of specific situations, probably becoming more of a control that individuals should expect to see. And actually, I think perhaps there's a growing desire for it as well. You know, you can imagine certain cohorts of individuals, certainly kind of as a result of the pandemic, who perhaps find themselves in payments environments now that they're less comfortable in, and would be very happy if the payment took a few hours to get through or a day. They don't need it to be there by the time they've logged off. So I think consumer sort of choice might also start to drive some of that slowing down.
That's an interesting point. Very good. Olivia came back to say she was thinking more around the lines of fraud typologies, like whether card fraud or APP fraud and associated controls, whether it's real-time screening. Because one of the things I wanted you to talk about was, you know, are there, and we've only got a very short period left, but real-time responses, getting real-time information is becoming more and more something that banks and fintechs are asking for. Does anybody just want to cover that in the last minute or so we've got left?
Well, I think if you've got real-time payments, you're going to have real-time fraud. And if you've got real-time fraud, you need real-time solutions to try to stop that fraud. And so it's really, I'd say, non-negotiable that if we are going to be, which we are, in an environment where customers are expecting real-time payments and they're using those channels, we have to have solutions that respond in milliseconds, not seconds. I think to just link it to the previous point, I think we should expect there to be probably more friction, maybe in the short to medium term, or more challenges for institutions to people around probably things like value and unusual payments. You know, if you're setting up completely new beneficiaries, you'd expect there to be more of a challenge, and it's an extremely large amount. No one wants to see their mortgage payment, for example, go to the wrong person. We've seen many examples of that. But I will say, to link it to blockchain, the more friction we put in place unnecessarily, the more I think move to things like stablecoin we'll see for international payments in particular, because these are ultimately very cheap new payment rails for people to move money relatively safely in their own right.
Thank you very much, Conrad. Good points. I'd like to thank you all for your time on the panel, and I'd also like to thank you. Looks like we've lost. I wanted to thank the audience for their questions, and if we haven't answered any of the questions, perhaps we can do those offline, and the recording will be made available after the webinar. So if there is any feedback, please do fill in the feedback form. Thank you. Thank you very much. Goodbye.